If you're into crypto, especially the smaller altcoins, you are probably feeling a serious chill right now. The market feels like it's stuck in a deep freeze. And the big question is, why? Is this just a temporary cold snap, or are we staring down the barrel of a new crypto winter? Well, let's dig in and figure out what's really going on. Okay, let's just jump right into it, because this is pretty startling. What you're looking at is an index of 50 smaller altcoins, the kind of projects that are often a great measure of how much risk investors are willing to take. And right now, that index is trading lower than it was during the complete and utter collapse of the FTX collapse. Think about that for a second. For these coins, things are worse now than they were during one of the darkest moments in crypto history. That is a massive red flag. So, what on earth pushed the market into this state? This wasn't some slow, gradual decline. This was a sudden, violent shock to the entire system. It really all comes down to a single catastrophic day. The catalyst for all of this was October 10th, when the crypto world got hit with the largest single-day liquidation event it has ever seen. Just look at that number, $20 billion. A sales wave of that magnitude doesn't just make ripples. It's a full-on tsunami. And it wasn't just panic. It was triggered by a chain reaction that just kept feeding on itself. To really get what happened, you have to understand this mechanism, a liquidation cascade. You can think of it like a digital avalanche. A big price drop hits, and that forces traders with leveraged positions to automatically sell. But all that selling pushes the price down even more, which, you guessed it, triggers even more forced sales. And on it goes. That $20 billion figure wasn't just people panic selling, it was the system itself, forcing a deleveraging at a truly brutal speed. And the hangover from that event is exactly what we're feeling now. Analysts are calling it a post-liquidation stagnation. All that speculative money that fuels the rallies in smaller altcoins, it's just gone. These smaller assets, the ones often held by you and me, the retail investors, they took the hardest hit. The appetite for risk has been completely wiped off the map. But here's the thing. That October 10th cascade didn't happen in a vacuum. Nope. It was the flashpoint in a much broader trend of fear and people just wanting to reduce their risk. And if you look closely, the clues are literally everywhere. What's so interesting here is how all the signals are pointing in the exact same direction. This isn't just one corner of the market. It's a systemic cooldown. Money is flowing out of ETFs, big-time traders are betting on prices going down, and even traditional safe assets like gold and silver are showing weakness. It's a classic risk-off environment. And this chart really tells the story in the ETF market. We're seeing some serious money being pulled from the biggest players in the game. BlackRock's massive Bitcoin fund saw $400 million in outflows in just 5 days. Now, sure, it's a small percentage of their total assets, but it's a crystal clear signal that investor enthusiasm is drying up fast. Now, in the derivatives markets, where the pros play, the story gets even darker. In the futures market, funding rates have been negative for a solid week. So what does that mean? It means traders who are betting the price will fall are so confident that they are actually paying a fee to keep those bets open. At the same time, in the options market, people are snapping up what are called put options, which is basically like buying insurance against a big price drop. So, we've seen all the data, but what's the big picture interpretation? Well, let's turn to the experts who spend all day, every day, analyzing these exact clues. Brett Munster from Blockforce Capital makes a really interesting point. He argues this isn't necessarily an indictment of crypto's long-term value. Instead, he sees it as investors just reacting to all the uncertainty in the broader global economy. When the whole world feels shaky, you pull money from your riskiest bets first. And for a lot of people, that's crypto. And Vettel Lundy from K33 Research, well, he basically confirms what the data is screaming at us. He's describing the current market using all the classic post-crash terms. Volume is dead, nobody's interested, and the number of people betting against the market is growing. The energy has just been completely sucked out of the room. And all of this brings us to the most important question of all. We know what happened, we pretty much know why, but the real question is, are we stuck here, or is there a light at the end of this tunnel? Well, it turns out the entire market, and I mean both crypto and traditional finance, is holding its breath for one very specific piece of information. The next major clue is right around the corner, and it all comes down to inflation. Okay, So here's what everyone is watching. This Friday, that's when the new U.S. Consumer Price Index data drops. If that inflation number comes in hotter than expected, it could put even more downward pressure on assets across the board, from stocks all the way down to crypto. It could very well be the event that decides whether this stagnation continues or gets a whole lot deeper. So that's where we are today, a market completely drained of its speculative energy, haunted by a historic sell-off, and now just nervously waiting for the next economic signal. The question is, will Friday's inflation data be the gust of wind that finally puts out the flame, or could it be the tiny spark that finally reignites the fire? We are all about to find out.